pre-tax versus tax-free. Which better? Which is better? It depends. All right, we're catching on. We're catching on. What if the tax rate and the growth rate is identical? Now, they're exactly the same to the owner of the account, but they're not exactly the same to the government. So, let's jump over here. I'm going to go into the traditional IRA first. So, inflow of income, $10,000. We're putting all $10,000 into the IRA. So what you can see here is we've got income tax, we've got taxes on that flow. So the income by itself would only produce $7,600 of spendable income. Since we're putting it into a pre-tax IRA, we don't have to pay that tax, and all that money goes into the account. Very, very simple. I used an 8% compounded rate of return. There's a whole slew of conversations we can have about what rate of return to use, whether you use speculative, compounded, all that. That's not what we're going to get into for this. And then you go from 35 all the way out to 65. And then I did reduce the rate of return down to 5% for retirement, just assuming the client would want to take less risk. You know, what would that produce in terms of an annual cash flow payment before tax all the way through age 90, where we end up at zero? That's the premise for both of these structures. So it's $90,000 coming out pre-tax. We accumulated to $1.233 million. We've got spendable income of $68,413 because that's pre-tax, so we've got to pay our taxes. Same tax rate across the board. We're using 24% the whole way. Roth IRA. Exact same mechanics, one difference. We're paying the tax, we're not deferring the tax. So $10,000 of income, paying the $2,400. In the Roth itself, we're contributing $7,600. So you can see that right here. So that's the after-tax contribution. Same rate of return, same time frame. We get out to age 65, we've only got $937,000, but we've got $68,413 of distribution and no tax. So I don't know if you caught it, and we're going to do a comparison here in a minute, but $68,413 and then oops, wrong count. 68,413. Spendable income. They're the same. So that's always the premise to start the conversation with the client around, well, should we do pre-tax or should we do Roth? Number one, get that understanding together that they're the same in a static environment. But what do we never have? A static environment. It's never a static environment. And there's tons of tools in here that you can show how not static the environment is. Additionally, so that's the same amount of spendable income. So what I'm going to do now, we're going to flip out to our comparison tanks, bring in our summary values. I'm going to skip to the end here. So down here at the bottom is our summary values. So you can see my cursor on the screen. So our net annual lifestyle, we already pointed out, the $68,413 is the same. Net cumulative for that entire lifespan is exactly the same. So whether it was the Roth IRA or the traditional IRA, we had no difference in spendable income. However, we did have a small difference, in taxes paid. The traditional IRA had $540,000 of tax paid. The Roth had $74,400 paid. The other thing that I like to point out with this one, so why does the government like pre-tax? Well, that's pretty clear. So we go back to retirement age quickly. So here, again, these summary values at the bottom are showing our comparison. So this is age 65. So on the Roth down here, you can see, from 35 to 65, we paid $74,400 in tax. So that's a choice. How long does it take us to pay that same amount of tax once we get to retirement, deferring the tax? We'll show you. 66, 67, 68, 69. Now we have paid $86,400 in taxes in 4 years, of which we paid $74,400 in taxes over 30 years. Now, take it one step further, and everybody on the stage or in the breakouts has been saying it. What do your clients think? Taxes are staying the same, going down, or going up? Going up. I think everybody in the room thinks taxes are going up. If taxes are going up, that problem only compounds tremendously worse. So again, when you're talking about pre-tax versus tax-free in the retirement plan space, some very simple tools to help you identify and show the math on how all of that works.